Hello and welcome to IPO Central on ET Now. My company in focus today is Pine Labs. It's a tech company digitizing digital payments and has issues solutions for merchants and consumer brands. Its IPO is opening on this November 7th, closes on November 11th, price between 210 to 221 rupees per share. It has a fresh issue of 2080 crores and an OFS of 1820 crores. In total, a 3900 crore issue, which is coming up on November 7th. And joining me today is Mr. Amrish Rao, who is the chairman and managing director and CEO of the company. Mr. Rao, thank you very much for joining us today on ET Now. To begin with, sir, let's start with the business model and give us an idea of what the business model is, and then let's follow it up with the kind of revenue model that you have.
Sure. Thank you very much. First of all, thank you for bringing me on this session of yours. Look, we are a very well diversified fintech company. We operate in the entire fintech ecosystem, doing everything from POS machines to doing online payments to doing bill payment services. But we also do what is called as issuing. So issuing of prepaid cards and issuing of accounts is something that we do. We believe that we are actually building one of the world's greatest fintech company coming out of India.
And can you also take us through the revenue model that you have? How do you get your revenue? Which are the segments which contribute most for your revenues?
So we operate in two large business lines. One is the digital infrastructure business line, and the second one is what happens on the issuing side of the business. On the issuing side of the business, about 30% of our revenues comes from there. There, what we do is we create accounts, wallets, prepaid cards, and we do all the back-end technology associated with it. And there we earn money on processing of transactions, so creating of accounts, holding of money, moving of money, processing of all payment transactions. That's where we make small, a few paise and rupees on every typical transaction, and that's about 30% of our revenues. The 70% of our revenues comes on the digital infrastructure side. Within the digital infrastructure side, one of the components is what we do on the POS side. On the POS business, you would have typically seen Pine Labs in all the major hotels, restaurants, retailers. That's the business that we are most famously known for. Less than about 50% of that digital infrastructure business actually comes on our POS business. The second component out here where we do a lot of volumes is where we do all these offers, campaigns, installment payment solutions on our terminal. So for example, if you go to any of the digital retailers and you go and make a purchase for a television, and you want to get that converted into installment payment transactions, we process those installment payment transactions. And that business of ours has been growing steadily over the last 4 or 5 years. And then the final component on the digital payments infrastructure side, we make money in terms of online payments and also what we do in terms of bill payment processing. In each of the businesses, we have two types of revenue streams. One, what we charge as a SaaS-based fees on a monthly basis to our merchants and banks and financial institutions. Second is we then charge by the transaction. We charge by the transaction. We also charge by the value of the transaction. That's how our revenues are spread out. As you would have seen in the RHP, last year we were able to show almost about 28-29% revenue growth on a year-on-year basis.
It's interesting. Do you think this area is getting crowded and there is a lot of competition here, and that brings in the question of whether the kind of transaction fees that you're charging, will that be under pressure going forward?
In many of these areas, we've actually been the market leaders. So we've actually seen that over the last 3 years, the GTV or the volume of the value which has been processed on our platforms has compounded at almost 60% over the last 3 years. The number of transactions on our platforms have compounded at 50% and more. And then what we've been able to show is we've been able to show a consistent revenue growth of more than 20%. In the last 3 years, what you would have seen is our EBITDA profile has gone from single digits to now to almost 20% EBITDA margin in Q1 of this year. So we have been able to show a consistent compounding at a revenue level, but we've also been able to significantly improve our EBITDA to almost 20% in Q1 of this financial year.
Just to come in here, when you're talking about EBITDA here, you're talking of the adjusted EBITDA and not the core EBITDA, because the core EBITDA is around 7.626% in Q1 and 9.6% in FY25, and your adjusted EBITDA is 19.57% and 17.25%.
You're absolutely right. I should have said adjusted EBITDA, where it is adjusted only for ESOP cost.
So, so when you say there's a 10% difference between adjusted and core EBITDA, which is there, how do you see the, these other costs, which includes ESOP and other legal costs and others, panning out over a period of time? Will that be phased out over a period of time, or is it going to be there for the next couple of years?
So one of the things that we have been focusing on is we have been focusing on ESOP costs. While ESOP costs are non-cash line item, but we have been very, very clear we have to focus on ESOP costs, and our ESOP cost is related to the ESOP policy. Just in the last few months, what we have done is we made a significant change on our ESOP policy, where we will now be issuing out ESOP no more at the deep discounted level. There will be a marginal discount, but it will not be at a deep discounted level, and that has actually been explained in the RHP also. What that does is that ensures that between the adjusted EBITDA line to EBITDA, the ESOP costs over a period of time, that has reduced in the last 3 years period as a percentage term, and you will get to see that in the RHP also.
What component or how much of quantum of deep discounted ESOPs are still there to be exercised? Because this entire thing of hitting the P&L happens only once they get exercised. So, what is the quantum of that amount?
So total ESOPs available to the employees currently today in the company is at about 9%. I don't have the exact number in terms of how the ESOPs will play out over the next few years.
Just to if you strip off the or if you take into account the entire ESOPs and look at the adjusted EBITDA also, which is there 19.57%, is that the nominal level of EBITDA adjusted EBITDA margins for you going forward?
See, we've been able to show a trend over the last 2 years, where I told you the EBITDA margin has gone from low single digit or low teens to about close to about 20% in this quarter. We do believe that trend is a sustainable trend. As long as the revenue growth in the company continues to operate at 20% and plus, our endeavor at all points of time is to ensure that the revenue growth continues to accelerate, and then at the same time, obviously the EBITDA will keep on improving as we have shown over the last 3 years period.
Mr. Rao, if you can give me a sense of the business scale up and the economies of this business, how it plays out, especially with respect to when you say that you're growing at 60% in terms of transaction value, the revenues are growing about 20% per year. So as the volume and transaction grows, is there a benefit of the scale and opportunity coming and flowing through the EBITDA and your profitability?
Absolutely. First things first, we are a technology company. Being a technology company, we obviously are able to show operational efficiency in the business. What that means is, as transactions go on increasing, as revenues goes on increasing, cost doesn't necessarily need to increase at the same pace, because we are a technology company at scale, and we are today operating at phenomenal scale. So for example, in Q1 of this quarter, we processed almost $46 billion of payment volumes on our platform. As scale increases, cost does not increase at that same pace. That brings in operational efficiency, and because of that, we've been able to show an improvement in the EBITDA. As we speak today, the top 5 banks in the country, all of them are our clients. The top 5 retailers in India are all partnered with us. The top 3 e-commerce companies are our clients. The top 3 Q-commerce companies are our client. So in terms of client diversification, revenue growth, we are operating at phenomenal scale. $46 billion is a great number anywhere in the world.
And if you can also elaborate on the 2080 crores that you are raising through fresh issue, how are you going to use that amount?
So we've actually identified where we are going to be using this amount. We've focused on 3 areas. One, obviously in terms of technology upgradation and new product development. Second, what we have said is that today 15% of our revenues comes out of global markets. One of the very interesting things is that fintech ecosystem that we have built in India is so unique and adaptable around the world. We think we have an opportunity to accelerate and export our capabilities into global markets. We are today present in about 20 countries, but we think we can expand into much more number of countries, and hence we've allocated some amount purely to international expansion. And then the last part is, as regards as net debt, we are today a positive company. We still have some debt out there. What we want to do is we want to retire some of that debt. So about 25% of the primary capital that we are raising, we will be using to retire some debt. But 75% of the primary capital is largely towards growth related activities.
How do you look at your clients from a revenue point of view? I'm trying to look at your RHP, and it talks about that your top client had contributed nearly 17% of your revenue in 24. It fell to 10.62 in 25, and in the first quarter it has gone down to 8.24. Why is that decline? Because it's not just a percentage decline, it's the absolute value decline as well.
So this is by all stretch, this is actually a good news. What we have been able to do is we've been able to move our existing clients into multiple products within the company. So we have actually seen, let's say there is a bank or a financial institution where we've had relationships over the last 10, 12 years. What they have done is they've actually expanded the revenue pool with us and gone into many new services. As I told you, all the top 5 banks in the country are clients of ours, may that be SBI, HDFC, ICICI, Axis Bank. These are all existing clients of ours, and we've only continued to expand our revenue pool with them. Similarly, what we have is we have a significant amount of revenue which comes from retailers, both in terms of offline retailers and online retailers. Earlier, for example, let's say if we were selling only POS related services, now we are doing POS, we are doing online, we are doing installment payment services. And in some cases, we actually issue out cards and wallets and prepaid accounts for them. Again, those revenues have also continued to increase with all of these retailers. Our keen interest is diversify the income from each of these accounts, move it into different products, and at the same time, as the scale increases, as we go into the mid-market in this country, we will have a much larger revenue base in the business. Again, I keep repeating on this topic is, I'm quite happy with the fact that we've been able to show a consistent 20% revenue growth within the company.
No, I understand that you're trying to get as much of money from various segments and through your clients, but your single client's revenue has fallen from 302 crores to 241 crores in 2025 and to now 50 odd crores in the first quarter. So the pool of revenue coming from a single client is also falling. Is there a reason why it's falling?
Well, that's because it's been changed around the multiple products that we are doing with the single client. So single client through various entities might be sitting, I don't know which one you're referring to, but it could be sitting between different entities within the business out there. If you actually look at our net revenue retention, and if you actually look at our relationship with all our top clients, these are all almost 7, 8, 10 years plus kind of relationship. It just could be a case where we are separating that out between different subsidiaries and different entities of this top client, and that's why you might be seeing what you're saying.
Could be. Give me also sense of your cash flows as well, because your cash flows are negative for first quarter. For FY25 it was positive, but it has again gone to negative. Why is that is going to negative, and is there a trend going forward that it may come back into positive, and it's as you grow your business you will have more cash flows coming from your operations?
I want to clarify out here. So on an adjusted EBITDA basis, FY24 we were at about 156 crores of adjusted EBITDA. Going into FY25, that was about 355 crores. So on an adjusted EBITDA basis, we've actually doubled our adjusted EBITDA on a year-on-year basis. And in this first quarter, which we have included in our RHP, our adjusted EBITDA has come in at about 120 crores out there. In regards to cash flow, as a payments company, there are invariably situations in which some of the settlements related to our clients and our merchants might be delayed. That obviously is a picture in time, and on a picture in time basis, you would get to see a cash flow mismatch which would be out there. But just in terms of our abilities to generate cash and to generate strong adjusted EBITDA, you would see that our track record is very, very strong over the last few years.
You also successfully ventured into overseas territory, whether it's Malaysia, UAE, Singapore, Australia, US or Africa. How big is this opportunity for you with respect to your revenue growth, and how fast are you growing in these geographies?
Currently, 15% of our revenues comes out of global markets. One of the things that we all really need to understand is one of the technologies where India is leading is when it comes to fintech. Our abilities to take our fintech products from India and global is extremely high. So when you go and meet up with banks and financial institutions or retailers, both online and offline retailers in some of the emerging markets like Southeast Asia, Middle East or even Africa, they believe in the India story. They want to work with Indian partners to build out their capabilities. We started off this journey in almost about 2019. We invested heavily in about 2022. And over the last 3 years, we've actually compounded at more than 70% in terms of revenue growth in global markets. As I told you, in this fundraise, one of the components is allocated purely towards international expansion. We see this to be as a very important part of our strategy in being able to take our technology products and take it international. One thing I would want to highlight out here is our technology product, we get paid by the transaction or the transaction value or a SaaS-based fee. We don't do any project-based fees in our operating model.
You had a profit of nearly 4.7 crores in the first quarter. Is it fair to assume that FY26 would be a profitable year for you?
See, as you know, SEBI does not allow me to guide to that. But what I can give you as a trend in FY24, my PBT was a negative of about 340 crores. In FY25, we were at a negative of 140 crores. And going into the first quarter, we are at a positive of 5. Even at an EBITDA level, as you know, we've been able to show almost 100% growth between FY24 to FY25. I do believe what we have done over the last few years is not a one-off case. We think we've been able to sustainably change our operating model and change our financial profile. And ideally, I would want to continue to do that.
Rao, it was a pleasure talking to you today. Your IPO is opening on November 7th. Closes on 11th of the month. 210 to 221 is the price band. 3,900 crores is the IPO size, and that gives the company a value of nearly 25,400 crores at the upper end of the price band. Thank you very much for joining us today on ET Now and coming on IPO Central.